Breaking news out of the White House, where U.S. President Donald Trump has signed tariffs on imports.
We're going to take it back, or something very powerful is going to happen.
The United States on the brink of a trade war that threatens to hurt American consumers and upend the global economy.
What's up, you guys? It's Graham here, and I can already tell that 2025 is going to be a roller coaster for investors. For example, just consider that in the last few weeks, artificial intelligence is now under attack from China. Brand new tariffs have created swift retaliation and chaos, causing the markets to begin selling off. The housing market is finally beginning to reverse in favor of the buyer, and most importantly, you can now purchase the Breaking Bad home for only $4 million. Yeah, I guess you could say they really cooked up that price. You better call Sol for financing. I'll stop. Anyway, in all seriousness, even though these last few years have been incredibly rewarding for anyone who stayed invested, there's a lot that could happen in 2025 that we need to talk about, with a few curveballs that could severely impact how much money you're about to make or lose. So with that said, here's my exact investing plan for the rest of the year, what history says is most likely going to happen throughout stocks, real estate, and cryptocurrency, the warning signs to look out for, and then most importantly, what you could do about this to have the highest chance of coming out profitable as soon as you hit the like button and subscribe if you haven't done that already. That's all I ask for. It's totally free, and as a thank you for doing that, I'll do my best to reply to as many comments as I can. So thanks so much, and also a big thank you to Policy Genius for sponsoring this video, but more on that later. Alright, so to start, what makes this year so much different from the last is that we're facing completely opposite political conditions than we did back in 2024. Like, just consider that in the last few weeks, dozens of executive orders were signed, which gives almost complete free rein for regulators to revamp entire industries. Banks can officially hold cryptocurrencies on their balance sheets without being seen as a liability. The IRS is scaling back down, potentially paving the way for lower taxes. And one bill proposes to eliminate the income tax altogether. Yeah, seriously. However, despite the market rallying on some very optimistic news, the sober reality is that the United States is still plunging itself deeper and deeper into debt, on pace for yet another collision course for running out of money. Brand new tariffs could severely impact the short-term future of our economy. The Buffett indicator is now at a level that's significantly higher than we saw prior to the dot-com crash, and UBS warns that 6 out of the 7 conditions are met for a stock market bubble, causing investors to worry. How much higher could this possibly go, and is there a chance that everything could begin selling off? Honestly, all of this has added a really confusing layer on top of everything else, because even though conditions do heavily favor the investor, prices don't just go up indefinitely without a few hiccups along the way. So in terms of what you could do about this and what's going on, let's start with number 1, the stock market. First of all, studies show that the average American is absolutely horrible when it comes to investing. In fact, statistically, the typical return that most people achieve is just barely higher than the rate of inflation. So if you don't take the time to at least understand this, you're not going to know what to watch out for. And it all begins here. In 2014, Business Insider released an article about why so many investors underperform the market and lose money, despite asset prices continuing to go higher. And just for some context, this was written when the S&P 500 had fallen to a low of about 1,800. However, despite this in hindsight being one of the best times to enter the market, a significant portion of investors simply cashed out and waited on the sidelines for things to recover. And little did they know, they ended up missing out on some of the best returning months of the entire decade. I mean, I'm sure we've all seen the chart that shows what happens if you miss out on the best performing days over 20 years. And what I found the most surprising is that only 40 days are responsible for whether or not you make or lose money. That's it. As they say, missing these days does so much damage because those missed gains aren't able to compound during the rest of the investment holding period. Likewise, they also found that the best performing days often occur right after the worst performing days, as you could see here. And on a practical level, they even analyzed fund inflows to determine exactly how investors did against the overall market. As you might have guessed, they found that fund inflows became most aggressive as the market peaked and outflows ramped up when the markets were near their lows. Or in other words, investors consistently bought assets that were overvalued and sold assets that were undervalued. So what does this practically mean for you in the year of 2025? Well, as I've said before in a previous video, most expert analysts believe the market is going to be going higher. For instance, Morgan Stanley, JP Morgan, and Goldman Sachs believe the S&P 500 will end the year at 6,500, and Oppenheimer came in with one of the most bullish cases, believing the market could rise another 20% by the end of December. After all, the market just had its best 2 2-year run in a quarter century. But that isn't always guaranteed to continue, as we're starting to see. Even though Trump's policies could theoretically boost spending, lift profits, and send us into an economic golden era, there is significant downside risk that tariffs slow growth, inflation reignites, and that begins to cause everything to start selling off, like we're seeing right now. In this case, Trump just enacted a 25% tariff on goods imported from Mexico and Canada and a 10% tariff on China, including a retaliation clause where if one country imposes tariffs on us because of the tariffs we imposed on them, then our tariffs would go even higher. Well, guess what just happened? In response to these quick announcements, Mexico deployed their National Guard to the border in an effort to make amends, and Canada enacted their own tariffs against US products, leaving the door open for even higher tariffs in the future. It's kind of like saying, if you don't make these changes immediately, I'm going to take $5 from you, and if you try to get your $5 back, I'm going to take $10 from you. Except with countries and a population of 500 million people. That's why the end result could be a GDP loss of 1.2% and a stock market sell-off, or it could be the greatest negotiation of all time while Mexico secures the border and avoids the tariffs altogether. At least for another 30 days. This is why I've always approached the stock market as a very long-term investment strategy with money I don't intend on touching for the next 20 to 30 years. That way, any of the month-to-month fluctuations really make no difference whatsoever. And once you begin to zoom out, you'll begin to realize that it's usually pretty profitable to stay invested. For instance, one way to analyze potential profits is by looking at what's called the rolling 20-year return of the S&P 500. This basically takes a snapshot to determine how much you would have made during any given time frame. And surprisingly, throughout the last century, a 20-year holding period has never once lost money. Ever. The reality is, the worst 20-year annualized return occurred in 1948 at just under 4% a year, while the best year started in 2001, with the market earning more than 16% a year. It seems as though for most years, you could expect an average return anywhere from 7 to 10%, with low returning years being boosted by some of the really high returning years. But in the short term, the honest answer is anything can happen. Like, just for some context, studies show that in the first year, you have a 73% chance of being profitable, which increases to 80% in the second year, 90% in the fifth year, and 97% in the 10th year, basically implying that the longer you stay invested, no matter what, the higher the chances are of coming out ahead. But as 2020 has shown us, things do happen that's completely outside of your control, and it often happens when you least expect it. For instance, like it or not, UBS says that as of right now, 6 out of 7 conditions are currently met for a stock market bubble. This includes stocks outperforming bonds over a 10-year period by at least 5%, earnings growth is slowing down, lack of diversification within the S&P 500, 25 years since the last bubble, this time is different, retail participation, and finally, the only one we don't have, loose monetary policy, which according to them means that we have a 35% probability of currently being in a bubble. This is exactly why I've kept the mindset that it's probably just best to dollar cost average into the markets on a regular basis, regardless of where it's priced, because I have absolutely no idea what's going to happen. Plus, even if we do see a sell-off in the near future, if you have a long enough time horizon, that's just a good opportunity to buy back in at a discount. However, in terms of what's going on with real estate, I hope you're ready for this, because this is a completely different situation, especially if you want to come out ahead profitable. Although speaking of staying profitable and getting ahead in 2025, it's not just about stocks and real estate, but also about making smart choices across all areas of your life. For instance, one of the best decisions you can make this year is to ensure that your loved ones are protected and have a financial safety net no matter what happens, and our sponsor, Policy Genius, is there to help. For those unaware, Policy Genius makes it easy to compare life insurance quotes from America's top insurers in one place with just a few clicks to find your lowest price. In fact, with Policy Genius, you could find life insurance policies that start at just $292 a year for $1 million of coverage. Some options are 100% online and let you avoid unnecessary medical exams. On top of that, their team of licensed award-winning agents work for you and not the insurance company, so they don't have any incentive to recommend one insurer over the other, and they can help find you the policy that best fits your needs. Not to mention, they can walk you through the entire process step by step, answer any questions you have, handle all the paperwork, and help you make decisions with confidence, with thousands of 5-star reviews on Google and Trustpilot. After all, your work life insurance policy might not be enough coverage for your family's needs, or it might not come with you in the event you move or change your job. Plus, the sooner sooner you start, the less expensive it is, since rates typically go up the older you get. So save time and money and provide your family with a financial safety net using Policy Genius. Just head to policygenius.com/Graham or click the link down below in the description to get your free life insurance quotes from top companies and see how much you could save. Again, the link is down below in the description to get started today. Thank you so much, and now let's get back to the video. All right, now here's where things get really interesting in terms of housing prices. First of all, it's no surprise that housing has been incredibly competitive, unaffordable, and let's just face it, very expensive since 2020. After all, low interest rate mortgages locked in existing homeowners from wanting to sell. An inventory shortage kept prices high. And current mortgage rate hikes absolutely obliterated home affordability. But now, Trump says that he could cut down the cost of buying a home. How? Well, according to his most recent executive order, many Americans are unable to purchase a home due to historically high prices, in part due to regulatory requirements that alone count for 25% of the cost of constructing a new home. And according to several studies, he's not wrong. Like on single-family homes, government regulation accounts for 23.8% of the overall cost, and on multifamily, it's a whopping 40.6%. However, critics of this argue that Trump's other policies, like tariffs, could actually have the exact opposite effect. For instance, a lot of builders get their lumber from Canada, which could add a 25% increase to cost, and deportations could raise the cost of labor since, let's face it, a lot of home builders use labor from out of the country. That's why if we want to tackle the housing problem, here's what we're realistically up against. According to Realtor.com, the US is facing a deficit between 2.5 and 7.2 million homes. So right off the bat, home construction would have to increase by a lot to even begin to make a difference, and federal regulations are only a very small piece of a much bigger picture. Like even if building costs can come down by 20% through getting rid of something like energy efficiency, that's unlikely to happen in the next 12 to 24 months. Prices are still 50% higher than they were back in 2020, especially when mortgage rates are at all-time highs. So the end result is still prices significantly higher than they were previously. To dig a little deeper on this, Trump's current executive order also lacks any detail as to exactly where he plans to cut the cost other than citing regulatory requirements, most of which, by the way, just falls back on the state and the city to make sure that developers aren't cutting any corners. Now, he did previously say that his administration would be open to using federal land to new housing development, although I have to admit, even though it sounds like a great idea, there's not a lot of federal land near any area a young person would even want to live, or even close to great job opportunities, so that could be a bit of an uphill battle. That's why, to me, the only way we could move towards housing affordability without political posturing is just by implementing one of the following. First, make it possible to take your existing loan and your interest rate with you to the next house. I don't get how this is such an impossible concept. Like, if you have an existing 3% interest rate with a $500,000 balance, you should be able to take that with you and apply it towards the next house that you purchase, and basically just keep your existing loan. If that happens, I guarantee it, sellers will then be unstuck from their current house, and they're going to want to move to a home that better fits their needs. Second, if you're moving nearby, you should be able to take the tax basis with you. The fact is, homeowners are sitting on record amounts of equity, and when their property tax basis is tied to their original purchase price, it makes it very expensive to pick up and leave. I'll give you an example of this. The home I purchased in 2017 has a property tax basis of $600,000, even though if I were to sell it today, it would be worth $1.2 million. This means I pay $7,500 a year in property taxes versus $15,000 a year at today's market value. This entices a lot of people to stay where they are because if they were to pick up and leave, their overhead cost would skyrocket, and as a result, they just don't list their home. Third, reduce capital gains taxes when you sell a primary residence. I know this one might be unpopular, but it's true. You have so many people out there who have owned their home for decades and they don't want to sell it because if they did, up to 37% could be taken away by state and federal taxes. Like, just imagine you bought a home for $100,000 in 1970 and now it's worth $3 million. Even with a $500,000 capital gain exclusion, that could be $800,000 worth of taxes gone just because you decided you wanted to move. Now, fourth, speaking of all of that, you should track the capital gains exclusion to inflation. See, for those unaware, back in 1997, a law was passed that allowed homeowners to keep up to $250,000 worth of profit if you're single, or $500,000 worth of profit if you're married, completely tax-free on a primary residence. However, back then, the median price of a home was only $124,000 versus today at $460,000. So if these values were adjusted accordingly to inflation, Homeowners today could see about $1 million completely tax-free, which would be about the same ratio we saw equivalent 30 years ago. And finally, 5, give tax credits to builders. I promise, if you eliminated or reduced taxes on profits derived from property development, builders would eagerly develop anything they can. Alternatively, if you were to give builders subsidized interest rates from the government as an incentive to build more, they will build a lot more. I hate to say it, but everything here is really just about money, and if builders had a financial incentive to construct lower cost units, they would. Although in terms of what you could do to best position yourself in the housing market over the next year, my advice is to only buy a home that you intend on keeping for at least 10 years and can reasonably afford based on your salary. Otherwise, in the short term, renting seems to be the better option across the country as it's a lot cheaper. Now, in terms of what I'm doing, I just haven't found any good deals in the real estate market lately, except for building out a guest house on one of my rental properties. In this case, I found a developer to build out a 2-bedroom, 700 square foot unit for about $200,000. I could safely net anywhere from $2,000 to $2,400 every single month, and all of a sudden, I'm making a 10 to 12% return on my money with a property that I already own. For anyone interested in doing something like this, by the way, if you live in California and you want to build out another unit, I'm using this company called Realm, and I was able to speak with them and get you $1,000 off if you use a link down below in the description. They're who I use to negotiate all the contracts. They've been absolutely incredible so far. I'd highly recommend them, so if you are interested, the link is down below in the description for $1,000 off. And lastly, the most controversial from all of this, we got to talk about cryptocurrency. Even though Bitcoin and pretty much the entire market has seen significant moves higher ever since Trump's election, a new rule could completely overhaul the amount of demand we're about to see, and that all has to do with banks. See, previously, if a bank or an institution were to hold something like Bitcoin on their balance sheet, they'd have to list it as a liability because it could be stolen, its price is very volatile, and it might eventually be worth nothing. So this prevented a lot of banks from ever holding it or allowing their customers to transact with it. Until recently, as of January 24th, the SEC overturned the previous ruling, now allowing banks to custody digital assets without calling it a liability. Even though it is too early to tell exactly how this is going to play out, I do think it's incredibly optimistic for the entire market, and my guess is that eventually more established banks will begin to embrace it. Separate from that, there have been a lot of floating rumors lately about the United States creating a digital stockpile or reserve for Bitcoin, which obviously would solidify it as a seriously value-driven asset. But in terms of whether or not this is going to pan out, so far the current executive order is rather vague, just stating that they will evaluate the potential creation and maintenance of a national digital asset stockpile, potentially derived from cryptocurrencies lawfully seized by the federal government through law enforcement efforts. So basically, it doesn't seem like they're just going to come out and say, hey guys, we're going to buy 2.1 million Bitcoin as the United States Reserve. Now the price is going to go higher. But the door is open, and there does seem to be potential for some demand in the future. Although in terms of where prices are heading, so far most analysts only seem to think it's going to be going higher. For instance, CoinShares believes that the price is going to end 2025 hovering around $80,000 to $150,000. Galaxy Digital thinks $185,000 is possible. Bitmining and Maple Finance both see $200,000 in the picture. And the most bullish comes from Nexo with a mouth-watering price of $250,000. Personally though, as far as what I'm doing, ever since the Bitcoin ETFs have come out a little over a year ago, I've just been dollar cost averaging on a regular basis and holding it through the ups and downs. So far, I'm proud to announce that buying the ETF has worked really well for me, but it's also a part of my portfolio that I'm willing to write off entirely just in the event that everything goes to shit. But in all seriousness, long term, I am bullish for Bitcoin. I do think the ETFs make it incredibly easy to buy or sell without worrying about self-custody, and I have a feeling over time, more people are going to begin diversifying into it, causing the price to go higher. But then again, I could be totally wrong, and it'll be interesting to look back at this 10 years from now and see just how well this has aged. That's why for 2025, my investing blueprint is pretty simple. 1, I'm setting aside a specific amount of money every single month to invest, and I'm sticking with it. Number 2, this is diversified across 75% S&P 500, 15% international equities, and then 10% within a Bitcoin ETF. 3, I don't intend on selling anything for probably the next 20 to to 30 years, so any short-term fluctuations really make no difference whatsoever. Now 4, I'm holding on to all of my real estate investments and making upgrades as necessary if it improves cash flow, like with the accessory dwelling unit. And then finally 5, I'm going to be repeating this strategy no matter what happens. Everything is really just on autopilot. Sometimes I don't even check what I'm doing. I just let compound interest do its thing, and that's how I'm preparing for a Trump economy in 2025. So let me know what you guys think of this down below in the comment section. I do my best to really read as many as I can, and if you disagree with me on something, just let me know. I'll be sure to see it. Thank you so much. As always, make sure to hit the like button, subscribe if you haven't done that already. Thank you so much, and until next time.